For those that missed out earlier, my name is Dan Burnell. I'm with Montana Chamber of Commerce. I am the Director of Operations. And it's my pleasure to introduce our next panel, talking about change. There's been some massive changes in how manufacturers recognize revenue and kind of the tax implications that we saw within some of the legislation from the federal government earlier this year. To help manufacturers navigate that, we're really proud today to have the team at Whipley give a presentation of what you should do as a manufacturer and how to move forward. It's my pleasure to introduce Nate McCarthy, Jennifer Clark, and I apologize I didn't have 10 cards for the rest of you guys. So
Mike Fuchs.
Kyle Perry.
So anyways, please give them a round of applause and thank for being here, and I'll turn it over to them.
So as Dan mentioned, today what we're going to be going through is some updates in financial reporting and then the Tax Act that went through right at the end of 2017. So these are two pretty dramatic changes for all industries, but for manufacturing also, it's a big change. So as Dan mentioned, I'm Nate McCarthy. I'm a CPA with Whipley, been with Whipley about 20 years. This is Jenny Clark, a tax manager here in the Missoula office. I know the introductions went through, but tell everybody what people do too. Mike Fuchs, CPA here in Missoula, an audit partner, and also our regional audit leader for the state of Montana, and then Kyle Perry, tax manager. So Kyle is a tax manager in the Helen office. So a little bit about Whipley. It is maybe the name Whipley is confusing. Who's Whipley? What does it stand for? Whipley is the last name of the founder of the firm. Our CPA firm is about 100 years old. We're a top 20 accounting firm within the United States. We have 49 offices across the United States, including 10 in Montana. We have about 250 employees in Montana. So within our practice, we do compliance work for businesses, but also consulting for businesses. In manufacturing is one of the largest focus areas within our firm. So today we'll be talking about one of the upcoming GAAP changes, which is revenue recognition. There's a number of others also. Lease accounting, there's changes to debt. Also for nonprofits, there's some pretty significant changes. But Mike and I are going to be focusing on ASC 606, revenue recognition. Jenny and Kyle are going to be talking about the Tax Cut and Jobs Act. Here too, it's an all-encompassing tax act, so it covers individuals, trusts and estates, but then businesses. There's some very significant changes to businesses. So we're going to be covering these at a pretty high level. We have a booth here. We'd encourage you to stop by the booth if you have some lingering questions, light bulb moments later on, like, oh shoot, they were talking about this, and I think I just thought of a question related to that. Love some follow-up. We do have our email addresses here, and the slides are going to be available through the conference. So with that, we will jump into ASC 606, the new standard. So really the biggest change to this standard is that we're getting away from rules and we're going to guidance. So as accountants, we're all wired to like checklists. You know, if this, then that. Show us how to do it. And we're going to tell us how you did it scenario, which doesn't feel quite right for a lot of people in our area. So this standard was passed back in 2014 and has gone through a number of delays, but is currently being enacted by public companies and will be enacted by private companies in 2019. And this is part of our convergent towards international accounting standards. So years ago, there was a vote within the AICPA, are we going to go towards international accounting standards? And the answer there was, no, we're not going to do it wholesale, but now one at a time, we're going to see that these standards are heading in that direction. So we have the revenue recognition change, lease changes, which are in 2020, are another area that same conformance between the two standards is coming into effect. So the revenue recognition standard is 1,000 pages long. There's thousands of pages of interpretive guidance. There's a lot to it, but it's a good time to start understanding it. What effect is it going to have on my business? How do I plan for this? What are the changes that I'm going to need to be ready for? So why is the revenue recognition standard such a big deal? Well, it's the largest change in 20 years. Organizations are going to need to look at each contract. So how many contracts does your business have? Do you have 3? Do you have 30? Do you have 300? Understanding the population of your contracts is going to be very important, and tracking of those contracts is going to need to happen. There's going to be timing of revenue recognition changes. So what does that mean? Currently, maybe we recognize revenue when something ships, but going forward, we're going to recognize revenue as we produce. So that's a new concept. And as with any financial statement change, this could change some of your, say, covenants. So you have covenants with a bank. The covenants say, okay, you're going to report on GAAP, and we're going to lend to you based upon inventory and accounts receivable. Well, what if you have a third current asset that is neither inventory or accounts receivable? It's revenues in excess of billing. How's the bank going to treat that? Are they going to use that as part of your borrowing base? It's a good time to be having those conversations with your banker to make sure that you're proactive there. You don't like how the contracts ultimately recognize revenue. So starting to look at that now in 2018 gives you the opportunity to potentially revise those in some cases. And you're going to want to work with your attorneys and CPAs. I was trying to think of a way on my drive over. So as I mentioned, I'm out of Helena. I drove over this morning. Proactive is such a common term. You know, we're going to be proactive in our personal lives. We're going to be proactive in business. So how do I make this sound different than proactive? And there's a number of construction zones right now between Helena and Missoula. In the car in front of me, it wasn't me, I swear, started speeding out of the construction zone a little early. And there was a highway patrolman right at the end of it. Flashed his lights and did this. So what's the highway patrolman saying? Change your ways or you're not going to like what's coming up. So to all the accountants in here, change your ways or you're not going to like what's coming up. You're going to need to embrace this and understand how it's going to affect your business and start moving that direction. So the core principle of revenue recognition is to recognize revenue when control of promised goods or services transfers to customers and in an amount that reflects to the consideration of a company expects to be entitled to in exchange for those goods and services. So this may sound kind of similar to what we're doing already, but it's a little bit more all-encompassing than what has previously been used. Within this, I don't know if that's a laser. The second bullet point here, in an amount that you expect to receive, this is going to include all variable consideration. So what if there's discounts? What if there's rebates? Commonly, I think we see those get booked on more of a cash basis. So first quarter sales go in at 100%, second quarter is 100%, third quarter, that's when the discount kicks in. So that's when we're going to book it. Those are going to need to be evaluated and potentially booked up front rather than waiting until they occur. We no longer transfer or recognize revenue based upon the transfer of risk or accomplishment of a certain task. It's not free on board shipping point, free on board receiving point. It's what do we expect to happen, and as I mentioned earlier, we may recognize revenue over the course of production rather than at shipment of that product. So the 5 steps for revenue recognition, we'll go through these in more detail. Identify contracts, identify the performance obligations, determine the transaction price, allocate the transaction price, and then recognize revenue when or as performance obligations are satisfied. One of the first trainings I went to on revenue recognition, the presenter talked about also the 5 steps of grief that kind of goes along with this revenue standard. Well, wow, that's a super dramatic way to talk about an accounting standard. But I've sat through enough meetings now that I've seen that happen. So along with the 5 steps of revenue recognition, I challenge all of you, maybe you're kind of new in your revenue recognition journey. Be honest and decide where you're at in this process. So the 5 steps of grief are denial, anger, bargaining. If you'll just take this away, I'll implement lease standards and I won't complain about it at all. Depression, and then acceptance. So I've dealt with a lot of anger. I'm looking forward to when we're moving forward out of denial and anger into implementation. So the first step, as I mentioned, identify the contract. Here, contracts can be verbal, they can be in writing. One of the items to note, cancellation for convenience. So you're going to learn a lot about how to evaluate your contracts, but one of the things I would throw out there to be very aware of is if you have a cancellation for convenience clause, hey, that's going to put you probably more towards recognizing at a point in time, more similar to what you historically have. So that's a pretty big deal. Do we have contracts with similar characteristics? Can we evaluate them as a pool versus one at a time? If you have high volume of contracts, that may be an approach that really works well for you. And as I mentioned earlier, how are you tracking contracts? How much time and effort is it going to take just to get to that point and know what contracts you have, and how are we linking those contracts to the revenue within the GL? As you read the standards, there's a lot of disclosure requirements for those of you that are on GAAP and then also preparing financials, that you're going to need to know this information as we get into 2019. The key is that you're not getting into your 2020, so your 2019 audit that's going to occur in 2020, and you're like, oh shoot, I haven't done this yet. I mean, that's a lot of time and effort at this point. So again, good time to figure it out, or you're not going to like the consequences. All right. Step 2, identify the performance obligations. So this is a good or service. You may look at your current good or service. We sell a car. We manufacture and sell a car. How does the market look at that? What if that automobile is sold along with a 2-year service contract or a multi-year service contract? Does the market look at that as an automobile with a service contract, or is it an automobile and a service contract? So from a performance obligation standpoint, we may get to a point where we recognize the revenue on that automobile sale, lump sum when it happens, cash and carry, but then the multi-year service contract is going to be amortized out over a period of time. So again, the contract is going to drive what the ultimate analysis is, but we also need to understand what our competitors are doing, what is the market doing, how is this going to be perceived out in the market to identify performance obligations. After you identify performance obligations, determine the transaction price. So I mentioned variable consideration earlier. The fixed pricing, I think a lot of us can get our arms around out of the contracts, but the discounts, the rebates, the return rights, what else is going to factor in, and what's the probability that that's going to happen? And Mike will go through some examples here in a little bit to give you an idea of how those work. So variable consideration, as I mentioned, you have to go through a probability. In here too, as accountants, we're kind of getting some guidance that we're not used to having before. So this probable and is there going to be a reversal? Is it significant that it will or will not occur? These are more touchy-feely than what a lot of us are used to seeing. So with that being said, how are you going to prove it to the person that's looking at your books? Is that the owner? Is that the banker? Is that your auditor? So whether you think revenue is going to change or not, you're going to have to analyze your contracts to prove that we didn't think it was going to change, the timing was going to change, and it didn't, or here's how it changed. And in factoring in variable consideration, and like with any management estimate, what process did you go through to determine how likely it was to occur? Did you have good historical information that you could factor in? Was there industry information available? I think you can pull a lot of information together to get yourself to a good point, but that process is going to have to include some good research on your part. Okay, so step 4 is allocate the transaction price. So here we have our performance obligations, we know the total contract price. Now we're going to have to pull it apart. How many performance obligations do we have? 1, 2, 3, and how are we going to allocate price? Is there comparable market information that we can allocate that price, or are we going to have to estimate the price? Different situations can maybe lead to a different end result, but here too, your process is going to involve some sort of research and information that's going to allow you to put that price to the performance obligations. And then step 5 is to recognize revenue. And so again, the couple of things I would reiterate. So this is for revenue where there's a contract. This is not cash and carry. This is not, other situations a lot of us encounter in our daily lives. This is for, in your case, we have a manufacturing contract. We're going to build X number of units and sell it in that manner. So those will likely be recognized over time. So how is that over time going to be determined? Percentage of completion, maybe some of you have heard percentage of completion. Historically, that's been a construction real estate term that over the course of a project, we're going to recognize revenue based upon our accomplishment towards completing that project. So that's a potential way of recognizing revenue, or more of an input-driven method. So the input-driven method is going to be resources consumed. We know it's going to take this to ultimately manufacture it. We've used 50%. We're 50% of the way there. If it doesn't get recognized over time, it's back to a point in time. So the point in time being the current revenue recognition system that we are primarily on. So the effective date, as I mentioned, public companies are going through this right now. So there's better information coming out every quarter. The public companies have quarterly filings. They're kind of blazing the trail for the rest of us. So we can see disclosures. We can see, the qualitative information that these public companies are putting together around their revenue recognition. For private companies, calendar year private companies, December 31, 2018 is going to be your next year end. January 1, 2019 is going to be when you implement this new accounting standard if you report on GAAP. So for the 2019 year, you still have to understand what effect this revenue recognition change had on 2018, because you're either going to have comparable information, 2018 compared to 2019. I think that's a pretty common format that a lot of us are used to seeing. So you're going to have to retroactively restate 2018 to conform with this 2019 guidance, or you can present standalone, but you're still going to have to take that change through retained earnings, the cumulative catch-up method that's called. So here again, being proactive on this, not waiting until late in 2019 or into 2020 is going to benefit a lot of companies. So some industry considerations before I hand it off to Mike to go through some examples. So for manufacturing, if I'm a manufacturer, what are my contracts? Do I have an inventory of contracts? How do I put that together? Is that a separate software system that I need to track all these, or is it a filing cabinet that I know where to go to track these down? Understanding of the contracts. What's my variable consideration? Identifying performance obligations, warranties. And having a consistent review methodology for each of these contracts is going to help you and your staff not come to an inconsistent conclusion. You're going to have a standard process that you can go through the same evaluation points on each of these. I think it's the French in me. My grandpa was French, and the French talk with their hands, so it's like I'm doing calisthenics. We'll see how many steps I have when I'm done. And then the cost capitalization. So like I mentioned before, you're going to have this new third asset, this revenues in excess of billing, well, there's a cost component to that too. It's gonna need to be deferred and tracked also. So, high level, a lot thrown at you. Hopefully you're beyond stages 1 or 2 of your grief cycle, just in this short session. I'll hand it off to Mike to walk you the rest of the way through that.
Thanks, Nate. We'll just go through, I think there's 3 examples here, but I want to point out that manufacturers are all different. I work with a lot of manufacturers, and everybody's contracts are different. What they're making is different, so it's all unique. But I think these are some pretty good high-level examples to give you an idea of what you're going to be looking at. I think the first example that we have is basically a job shop. So you got a company that's was contracted to manufacture 100 different widgets, and then there is some clauses in the contract that the company can recover costs that they incurred, if the customer didn't accept the widgets and so forth. Under current GAAP, if you manufactured, say, 50 of them before the end of the year, but they're still sitting in your shop, you're probably not going to recognize that revenue. Most companies aren't. They're not recognizing it, and probably till they ship it or deliver it, as Nate mentioned earlier. Under the new GAAP, ASC 606, basically, if you had manufactured 50 of those by the end of the year, you're going to recognize 50% of that revenue on your 12/31 income statement. So it's much different, so you can see where there can be a significant change in what you're showing as revenue at a point in time. Over time, it's going to be the same, but at a singular point in time, and if that's your balance sheet date, there can be a significant change in what your financials look like under the new GAAP versus the old GAAP. The next example is sell-through method. If you're using distributors, a lot of folks, what they would do with the distributors is they manufacture, you send the information or the goods to the distributor. You're not recognizing that revenue until the distributor actually sells your product. Under the new GAAP, you're going to recognize revenue when you send it to the distributor itself. So when you actually relinquish your rights to those goods. So that's also a significant change in that example. The third one that we have talks about some volume discounts. And the answer's already there, so it'll be easy. But if you offered a customer a volume discount if they bought a certain number of units. In this example, it's 1,000 units. So in the first quarter, you go through it and you sold the customer 75 units at $100 a piece as your standard price. You'd book $7,500 worth of revenue because you don't believe that they're going to reach their volume discount factor. The second quarter comes up and you sell 500 units to the customer, and in that, you're going to look at it and say, well, I think over the next 6 months, remaining of the year, they're going to reach that 1,000 units. And so they are going to achieve that volume discount. It's more probable than not, is how the standard's written. And so when you're booking revenue in your second quarter, you're going to take the reduced amount, the $90, because you're giving a $10 discount. So you're going to take 500 units times $90 is $45,000. But you're also going to reduce that by the amount of discount on those units that you sold in the first quarter. So there was $10 times 775 units is $750. So you got 45,000 less the 750. You come up with 44,250 if I can do my math right without a computer or a 10 key. So, you can see there's a significant difference there of how you may recognize that revenue. As Nate stated earlier, a lot of times you maybe wait until the end of the year and maybe book it, or maybe wait until they reach that volume number, those 1,000 units, and then book that discount. But here, it's more probable not that they're going to reach that discount, and so when you start reducing that recognizing that revenue differently. So, like I said, everybody's different, so, I mean, those are, I think, some fairly straightforward examples. Those are, if they were all like that in real life.
And I would just mention one thing. So calendar year, maybe you have calendar year contracts, evaluating the duration of your contracts too. And Mike and I have talked about this with some clients. So everything closes within a month. We sell, we get paid, we're done manufacturing. You know, that's probably a different type of analysis than contracts that span a year end or multi-year type contracts that, you know, recognizing this at a year end or at one of your reporting periods could really change, so.
Yeah. I think the last slide here before I turn it over to Jenny is, you know, we kind of say how Wifley can help. I think Nate used the term proactive, and maybe that's not the best term, but I think our firm has been fairly proactive with this, but we can provide training, you know, perform readiness assessments, even if your current maybe CPA that you're using isn't there. We can help analyze those contracts. In this standard too, even if you decide that you're not going to recognize revenue any differently, there's probably 2 or 3 pages of footnotes, whether you do audit, review, compilation, there's probably 2 or 3 pages of additional footnotes that need to go into your financial statements. So we could even help do that analysis and help write up the footnotes and help with your, develop your policies, internal policies, those types of things. So. I know that's quick and dirty, just very high level, but again, like Nate said, we'll be out at our booth afterwards if you have any more specific questions. So with that, I'm going to turn it over to Jenny.
Thanks, Mike. So like Nate mentioned earlier, so the revenue recognition standard is probably one of the more significant changes impacting financial statement reporting. Similarly, the Tax Cut and Jobs Act is probably one of the most sweeping overhaul tax law change since '86. And so it not only does it impact businesses, it also impact individuals, estates, trusts, but today I'm only going to cover the tax law changes that impact specifically related to manufacturing businesses. So the first one I'll go over, one of the main changes is around corporate tax rate. So historically, the highest corporate rate was set at 35%, but since January 1st of 2018, that has decreased to a 21% flat tax rate. This provides significant benefits to C corporations. However, there is an adverse impact to businesses with taxable income that fall within the 0 to 50,000 taxable income bracket. Other than that, it's a pretty big significant change. Additionally, the tax bill also repealed the alternative minimum tax for corporations only. It's still applicable to individuals. Another major change is on methods of accounting. So historically, for a small business that hold inventory within the manufacturing industry, you are required to use the accrual method of accounting unless you fall within an exception where your average gross receipts is less than $1 million or $10 million, depending on the industry that you're in. With the new tax law change, that threshold was increased to 25 million. However, there is a caveat. The inventory has to be non-incidental supplies and materials, or your financial statement or the method of accounting has to be consistent with your financial statement. Additionally, if you are a corporation or a partnership with corporate partners that don't hold inventory, you can now use the cash method of accounting as well, as long as your average gross receipts for the prior 3 years is 25 million or less. Where our thought is that most of the manufacturing companies that hold inventory won't qualify or won't be subject to the cash method of accounting due to financial reporting purposes. Another significant change is on depreciation. So the first one is around bonus depreciation. So the tax law increased how much you can depreciate from 50% to 100%, starting at the end of 2017 all the way through the end of 2022. And then that percentage is decreased from 80% to 20% from 2023 through 2026. And the law also expanded the type of asset you can acquire and depreciate to include used property as well. So it's available to new and old. The new tax bill also increased Section 179 deduction from 500,000 to 1 million. It also increased the spending cap on the qualified assets you purchase from 2 million to 2.5 million. And so that's what that spending cap is for, is once you have acquired 2.5 million of fixed assets, anything over that, your deduction is reduced on a dollar for dollar basis. It also expanded on the type of assets that you can depreciate as well, or subject to the 179 accelerated depreciation. So excess business loss, this is a new provision that came out of the tax bill. This is more applicable at the shareholder and partner level, but essentially it's a limitation on active losses from a pass-through entity. So this is very similar to passive activity loss. So if you're not actively participating in an S corp or a partnership, then any of the loss from that business would be limited. However, that wasn't applicable to active participant owners, but now it is. And so the limitation is 500,000 for joint filers and 250,000 for all other taxpayers. And similarly, because those losses are suspended, you can carry it forward and offset future income. However, with the new tax bill, your carryover, how much you can offset your future your taxable income with your net operating loss, you can only use 80% of that, and the rest has to be carried forward. However, that net operating loss can be carried forward indefinitely. It just can't be carried back anymore. I would say this is probably the most, this is the Section 199A deduction is also a new provision, and it's probably one of the more significant changes that impact businesses in the manufacturing industry, and also just pass-through businesses such as S corps and partnerships. It's a pretty complicated code section, and we're still waiting on IRS guidance, which we're expecting that to come out later this summer. But just to kind of give you an overview of this deduction, so starting at the beginning of this year, individuals, estates, and trusts that have an ownership in a pass-through entity. So it could be either an S corp, partnership, sole proprietorship, that file a Schedule C, or even if you have rental activity that file a Schedule E. You can take up to 20% of your domestic qualified business income from that pass-through. This deduction is applied at the shareholder and partner level on a business-by-business basis. So if you are a shareholder in more than one pass-through entity, you would have to do this analysis at each business level. And then there are several limitations to this deduction. One of the main ones is one of the main limitation is related to specified service business, which I'm not going to cover because it's not applicable to manufacturing companies. But the other limitation is based on the shareholders and partners' taxable income level. So you're eligible for the 20%. You're eligible for the 20% deduction of your qualified business income. However, that deduction could be reduced depending on where your taxable income level falls. So if you see up above, for single filers, the deduction is reduced if your taxable income falls between $157,500 to $207,000. And then for married filing joint, $315,000 to $415,000. And there's certain exclusions from how you determine qualified business income, such as shareholder compensation or guarantee payments. But once you figure out what your qualified business income is, then the deduction is determined based on either 20% of that or the greater of 50% of the business's W-2 wages, or 2.5% of the W-2 wages plus 25% of the cost basis in the assets. So this is a pretty complex calculation on how you can determine what you are eligible for. We do have a flow chart to kind of walk you through the steps. And so really, for manufacturing businesses, you would want to focus on the right side of the flow chart because everything on the left is related to specified service businesses.
This makes revenue recognition seem easy, doesn't it?
And we'll be out there too after this, so feel free to stop by if you have any questions or anything related to this. But I think the takeaway is really to understand where your taxable income falls, because that will eventually drive what you're eligible for as a deduction at the end of the day. Because if your taxable income is below $315,000 and you're a married filing joint taxpayer, you're automatically qualified for the 20% deduction. Where it gets a little complicated is once your taxable income increases above that 315, then there's a few different limitations and factors that need to be considered. And some of the planning opportunities that could kind of help determine where your taxable income level can fall at could include looking at depreciation, whether or not to take additional 170 to capping out on your 179 deduction to lower your taxable income, or if bonus depreciation makes sense for you to also reduce your taxable income. So there's a few different options to look at. Another area this would impact is also trying to determine which entity structure makes the most sense. So This deduction is eligible to pass-through entities. Well, there's several different entity types. There's an S corporation, there's a partnership. You can set up as a single-member LLC. And so depending on how you're structured, it could also impact your deduction as well. So this is just a quick example, very high level, where it's a manufacturing company, there's no employees, very little assets, and the ordinary income, and it generated ordinary income of $600,000. So if the entity is set up as a sole proprietor, the business can't pay its owner a salary. However, if it's set up as an S corporation, then the S corporation is required to compensate its shareholder a reasonable compensation. So in this scenario, it would be $100,000. If it's a partnership, then the partnership can pay a guaranteed payment for services rendered, and also in this example, it's $100,000. And so just kind of going through each entity based on the scenario. For a sole proprietorship, you're not reducing your qualified business income by wages. So your QBI remains at 600. And so based on the limitation, the taxable income is over the threshold of 415. Let's say that this is a joint taxpayer, then you have to look at the lesser of the 20% or 50% of your W-2. And so as a sole proprietorship, you're not eligible to the 20% deduction. However, if it's set up as an S corporation, you have to reduce your qualified business income by the W-2 wages you paid. And then you determine your deduction if it's 20% of qualified business income or 50% of your W-2 wages. So as an S corp, you're limited to the W-2 wages of the $50,000. And then for a partnership, since guaranteed payments is not considered wages, again, you're limited to 20% of your QBI or 50% of W-2 wages, which in this case, the lesser of the two is 0 as well. Again, this is it's a very simplified example, but it does show you that depending on how your business is structured, you could either maximize your deduction or it could also reduce it by a significant amount. So some of the other changes, one is related to like-kind exchange, so Section 1031, which is now only limited to real property. So historically, you can do a 1031 like-kind exchange for personal property such as a vehicle, but now it's only limited to real property. Probably the biggest one is the domestic production deduction, that 9% deduction that manufacturing businesses were qualified for, but now that has been repealed. But I guess what Congress did was they replaced it with that 20% deduction. Entertainment deduction used to be allowed, but now it's 100% disallowed. Interest deduction, and this one, it's more if your average gross receipts is 25 million or more, but if it is, then your interest expense is limited to 30% of your income. And then also R&D expenditures. So beginning in 2022, R&D expenditures has to be capitalized and then amortized over 5 years. This doesn't have an impact on the R&D tax credit, which I'm going to turn it over to Kyle to kind of talk about that a little bit.
Thanks, Jenny. Just two things before I get started here. One, I was impressed that everyone elected to come here and listen to four CPAs talk about exciting rule changes. And two, I'm ecstatic that it's being filmed, so that if I have trouble falling asleep in the future, I can turn it on and go right to bed. So the R&D tax credit, I know we're short on time here, but you know, as a manufacturer, it's something you probably really should be looking at. I think most, if not all, would qualify at some level for this credit. And really, it comes down to, are you manufacturing a new product? Are you manufacturing something for the first time? Are you improving processes? Are you just trying to become better at what you do? All of that stuff kind of qualifies for research and development. So it's not white lab coats and beakers in a secret lab pouring stuff together. It's really improving your business, and it's the costs of the people who work on those types of activities. It is special equipment that you've purchased. If you need to modify it, that type of equipment would go into the credit, as well as any materials and supplies used to manufacture something for the first time. As an example, I had a plastic injection molder who made tanks for the backs of John Deere tractors, and they were going into manufacturing Yeti coolers. And so, that whole process of, getting the molds down and, reducing waste and all of that activities were, research and development for this client. And it doesn't have to be groundbreaking, new to the world. It's just new to your company. So, there's a lot of things that you wouldn't think that would qualify that do, and we've got a team of people who are 100% devoted to R&D, and that's all they do, and they can go in and sniff it out. I spend about half my time with that team here in Montana, going around to the different companies and trying to maximize that credit. Additionally, if you have been claiming the credit, it may be time to look at and revisit it. A lot of times, there's court cases that come up, there's new regulations that are issued by the IRS that make it more attractive to claim the credit than it was in the past. So now for startup businesses, you can offset against payroll taxes, so you don't have to be making money, you just have to be paying people. It also can now offset AMT, which, as a small business owner, if you or an S corporation or a partnership, and it was passing through to you before, those credits wouldn't offset AMT, and so a lot of people, it wasn't really worth the time to go through the calculation, but now it can, and so definitely a time to revisit. If you thought, well, we didn't really qualify in the past, you may now, and more than happy to work with your current tax provider. Wouldn't really want to go in and poach the relationship. We can just come in and do the R&D credit and give your CPA the forms, and they can throw it in the return, and then you get the benefit. So, really something to look at. We're also in the business of maximizing the credit. If it was set up for you in the past and you just are taking it kind of based on what you've done in the prior years, we can come in and make that bigger generally, and also help with shoring it up for audit defense, because it is an area that the IRS looks at pretty heavily. So, yeah. Stop by the table and grab a card, and be more than happy to talk to you about it further.
To go along with Kyle's comment about it being videoed, if you would throw this on YouTube, Dan, my kids would know what I do. So thank you again for having us. Really appreciate the opportunity.
Well, thank you, Nate, and thank you, everybody at Whipley, for doing this presentation. Just to echo the challenge that you had, not only is talking about tax policy and accounting standards, it was also after a heavy lunch, so glad to keep everybody awake. So please, a round of applause for the team at Whipley. If it's okay, we're going to skip by questions. If you have questions for them, they're out there. Please talk with them. It'd be great. Right now, I'd like to introduce Robert Steiner, if you could come up. Robert Steiner works for the U.S. Small Business Administration. He'll be doing a presentation, and welcome, Robert.
I appreciate the opportunity to be here. My name is Bo Steiner. I am the Deputy Associate Administrator for the Office of Field Operations with SBA, which is probably the longest title of anybody in government, I think, at this point. But my job is to oversee the field organization for the Small Business Administration. And what the field team does is they make sure that SBA's programs are implemented in the way that is most efficient and effective for our small businesses and entrepreneurs. I think everybody here probably knows who the SBA is, but we're an independent federal agency. We're focused on helping small businesses and entrepreneurs start, grow, and thrive in their businesses. So it's a great organization. You've got a great field team here in Montana. You've got a couple of folks here. Wayne Gardella is in the room. So, I know Wayne's a big advocate for our small businesses. What Wayne asked me to come, Wayne and the Montana Chamber asked me to come and talk about was a little bit about manufacturing, but looking at it from a macro level, like what's happening across the country, what are we seeing from especially small business manufacturing across the United States. So I wanted to touch on that, and I think background and kind of the lens through which I view manufacturing comes from growing up in Ohio, which is a really heavily manufacturing state, small town, 20,000 people. Anybody go to Home Depot and buy Worcester brush, like that's the kind of company that sustained the economy in my community. The Worcester brushes, the Akron brass, these kinds of companies that provided good jobs to people in the community that sustained a whole bunch of other jobs within the community. So I have that experience. Before coming to government, I worked for a semiconductor manufacturer and for a medical device manufacturer. So have some close experience with what manufacturing means. And personally, as an engineer by education, I love the idea of making something out of the raw materials. I think somebody said that during lunch, and I love that because it's like you're really creating something. And that's just, I think the bottom line is really making those products that make people's lives better and solving their problems. So I'm really excited to be here, and I love talking about manufacturing. And by the way, everybody asks me this whenever I talk to them. This is my first time to Montana. So I'm taking any and all advice on, I can't stay long this trip, but when I come back, any advice on where I should go and what I should do, because everybody that I've talked to, that's been the first question, and I appreciate that. So as everybody here knows, I mean, you're all here because you're thinking about manufacturing and exporting and the impacts, not only from an economic perspective, from a job creation perspective, but what it also means for the community. So what are those other things that happen when you have a strong core manufacturing environment? And I was going to touch a little bit on the exporting piece as well, because that's really part and parcel to what we do or what you do as manufacturers, is look to expand your marketplace. I've got a few stories to tell about some of the businesses that I visited that are exporting to places you might not expect them to have success exporting. But because of their products and because of the quality that they've implemented, they're able to penetrate these markets that you'd be like, wow, I figured somebody would have just copied that and made it there, but they just can't do it. So, but the numbers speak for themselves. Manufacturers contributed $2.25 trillion to the U.S. economy in 2016. And this figure has risen since the second quarter of 2009, which was obviously the kind of depths of the recession, where it was about 1.9 trillion. And in 2016, manufacturing accounted for about 11.7% of the overall economy. In from the perspective of Montana, as you probably all know all these stats, but in 1997, manufacturing accounted for 25% of Montana economic base. And in 2015, it represented 27.5. So if you look at the stats, and I'm sure you all are familiar with it, I think over the past several years, manufacturing in Montana has grown about 18%, which is one of the highest growth rates across the country. And I think it identifies that Montana is doing some things right in bringing in new manufacturers, but also helping existing manufacturers to expand. taken alone, manufacturing in the United States is would be the ninth largest economy in the world. So that includes the United States. So just manufacturing in the U.S. would be the ninth largest economy, which is huge. And that's according to the International Monetary Fund. So, those statistics are there. And obviously, we're the small business, and the vast majority of manufacturers are small business. In 2015, there were 251,774 firms in manufacturing, with all but 3,800 considered small. So it's pretty significant. And when we talk about small, as you all are working this space, there's a million definitions of what small means. It could be by the number of people, it could be by the revenue. In this case, we're talking about number of employees. So 500 employees or less would be considered small. If we want to talk about government contracting programs, we can get into a whole other discussion about size standards. And in Montana, manufacturers are small business. There are about 600 establishments with 1 to 4 employees and 280 with less than 10. And there were no Montana manufacturers with 500 employees or more. So it's all small business here. And from a jobs perspective, manufacturers have a huge impact. There are around 12.5 million manufacturing workers across the country, accounting for 8.5% of the workforce. And since the recession, manufacturers have hired more than 1 million workers. And if you kind of break it out, there are 7.8 million and 4.7 million workers in durable and non-durable goods, respectively, according to the Bureau of Labor. And so when we think about the jobs, we also talk about that multiplier, which has a pretty big effect on communities with strong manufacturing bases. So there's studies that say that one manufacturing job creates anywhere from 5 to 20 additional jobs outside of that core manufacturing. And that could be because of the supply chain. So you have, the main company that's making the fully formed product. You've got other companies that are supporting that. You've got where I grew up, my dad was an insurance salesman, right? He's going out and he's selling his products to all of the folks that need car insurance. They work at the Worcester brush factory or whatever. So, it just creates this whole economy around that in a way that you don't see in other industries. Maybe the service industry or even you see in a lot of areas, like medical services is one of the huge industries, or home health care, that doesn't create a lot of other jobs around it. So manufacturing is huge in that respect. And we talk about Montana manufacturing employment increased from 16,400 to 19,400 in 2016. And that was in 2010 to 2016. So increase of 18%. So one of the things that has happened happened over the few years is people start talking about the improvements in efficiency in factories, right? We're getting more output for the number of workers that we have that are working in these workspaces. From 1997 to 2015, from 1987, to now, the average increase was about 2.5%, or 2.5 times increased productivity. So significant advances. How is that happening? You've got lean, right? Everybody's looking at, how do I remove constraints? How do I streamline my business? I don't know if anybody's read The Goal by Eli Goldratt, but it's like kind of that classic theory of constraints. How do we remove these obstacles that'll keep us from getting that product out the door? We've started implementing technology, right? Everybody, you've probably all seen, right? You go into a factory now, there's a bunch of robots, and there's people that basically manage all the robots in a lot of the factories. That's not all factories, but in a lot of manufacturers, that's the case. When I was working at Stryker, it's a medical device industry, or a medical device company. Obviously, they're making surgical equipment, so it was really clean, but it might as well have been a surgery in there because, totally white floors, white walls, everybody's got their suits on, the whole thing. But it's not just those kinds of industries where that's happening. I was speaking with somebody who is a Coast Guard commander, and the Coast Guard's building new frigates for their fleet. And he said that when he went to the shipbuilder, it was that same setup. It was all automated, all clean, and they have major processes involved in getting things from point A to point Z. And so we've made these factories more efficient. The other thing that I think, I'm sorry I don't know your name, but you mentioned is safety, right? So these workplaces are safer. We don't have people getting hurt all the time, which again, if people are able to come to the job, that means that they're able to be more productive, contributing to those outputs. And then finally, if you're using robots that are more precise, obviously you hopefully have less rework because you're more precise in how you're doing your processes, and that increases your overall output. So those things are helping us to increase the efficiency. One thing that when I've been doing some research that I found was that there's no credible studies. We hear about robots taking all the jobs from the employees in a lot of ways, but there's no credible studies that actually say that's the case. In fact, they say that the number of jobs required has been fairly consistent. What is happening, and we'll talk about it in a minute, is maybe we don't have the workforce to support those jobs as they've evolved, right? To go from more of a manual position to, hey, I'm more of like managing a computer and managing a system. But I found that pretty interesting because you always hear like, oh my gosh, all these robots are costing everybody their jobs, and it's really not happening. It's probably actually raising the level of technical expertise that's required, and associated with that, increasing the pay and compensation and benefits that they all receive. So it's kind of exciting if you think about it, and with the focus on manufacturing right now, I think it's a good thing for both businesses and for their employees. And let's talk about the employees for a second. When you look at good jobs, and we always talk about good jobs, right? We don't say that minimum wage jobs are those good jobs. And manufacturing represents those kinds of jobs that are good jobs. In 2016, the average manufacturing worker in the US earned $82,000 annually. The average worker in all non-farm industries earned $64,000. So significant gap, right? 75% from there. Looking specifically at wages, the average manufacturing worker earned more than $26.50 per hour, not including benefits. And that's the other piece of it, right? Most workers in manufacturing operations have benefits. They actually have health insurance. They have other benefits that help them make ends meet, which a lot of folks that aren't working in those industries don't have. And we're seeing that across the board, and I'm sure that's the case in Montana as well. But that kind of raises the issue that I've heard a number of times today is identifying those right workers to fill those jobs, right? That's the other constraint that we're seeing across the country. So an example, I was in Illinois, and I was in a more rural area, not a huge population, but they had like 5,000 jobs in manufacturing that they couldn't fill because they either didn't have, it wasn't even that they basically couldn't find the talent at all. They were willing to train the employees, the businesses were willing to train the employees, but they just couldn't get people that could pass the drug screen or do other things. So it's a huge issue, number one, just to find the talent that you can bring on board. Even better, how can you train the talent? I was reading a Washington Post article the other day that talked about this topic, and it said that they used Grand Rapids, Michigan as an example. So in order to try and bring manufacturers in, instead of focusing on things like tax breaks and things like that, what they did is they focused on workforce development efforts. So they looked at bringing in the right kind of workers. So they invested in the community colleges and education and other mechanisms that would help to drive businesses to say, hey, we need to move here because we've got the workforce to sustain it. Yeah, it's I think, and it was a lot cheaper overall than what the tax breaks and all those other things end up costing the community. So it's kind of an interesting model, at least thought experiment to think about how can we look at things in a different way in order to recruit more businesses to our communities. Because what you see with, where's Amazon going to go? It's like everybody's given up everything. They're not going to make any money out of that except for the taxes from the employees that come in. And is that the best route to go, or is there other ways to bring in those employers that can help us grow? So, in any case, right now, the Deloitte and the Manufacturing Institute say that 80% of manufacturers report a moderate or serious shortage of qualified applicants for skilled positions. And I think there's the expectation that we're gonna have, over the next 10 years, we're gonna create 3.5 million new manufacturing jobs nationally, and we're gonna be short about 1 million people to fill those jobs. So we gotta figure out that, because in speaking with Wayne and some of the other folks here who are in the more investment side, right, the access to capital piece, there's a lot of businesses that would like to expand, maybe add a third shift, add some more equipment, but they just don't have the staff to actually execute. Were they able to secure funding to move that direction? So it's and again, these are things that we're seeing all over the place. This isn't just isolated to Montana, but it sounds like, again, it just reinforces what we're seeing out there. But it does sound like Montana's got a lot of momentum towards working together to figure out these solutions. I was speaking with Department of Commerce earlier today, talking about how do the entrepreneurial resources collaborate with the workforce development folks who collaborate with the economic development organizations to work together to make sure that you start to build out that environment that's going to support manufacturing as well as other industries that you want to bring to the state. But that's really crucial, that collaboration. And probably the big challenge, because you have a gigantic state here, but with that comes an opportunity to think about doing things different ways, using technology and those sorts of things. So again, the more that you all can work on, and you continue to collaborate to support that workforce, gives so many more opportunities to grow the local businesses, and especially in manufacturing, where you need that talented workforce. So talked about manufacturing. I did want to touch on exporting a little bit, because I hear a lot of folks that are doing a lot of exporting here. And when I look out across the country, so I was the district director in Illinois, so we have a lot of small manufacturing operations there. And more and more we're seeing that those that export are the ones that are leading the charge as far as growth, as far as opportunity, and actually even in employee compensation. So businesses that export pay their employees like $96,000. We talked about $86,000, I think, for manufacturing. It's like $96,000 for exporters. So exporting is good for business for sure. Over the past 25 years, U.S. manufactured goods have quadrupled. Manufactured good exports have quadrupled. In 1990, we as U.S. manufacturers exported $330 billion in goods. By 2000, that number had doubled to $708 billion. And in 2014, reached an all-time high for the fifth consecutive year of $1.4 trillion. So So we continue to export. You may think independent of all that you hear about manufacturing is not dead in the U.S. It's still here. And the U.S. has 20% of manufacturing globally, which is still first. You hear like China and all these other places, we're still number one. But we've relied on selling inside the U.S. as opposed to exporting, right? So exporting is that opportunity. And you look at countries like Germany, right? They have a huge exporting model, a lot of small manufacturers. They've kind of figured it out. And that's where we've got to help our small manufacturers to expand their target range. And I think, there's a lot of action happening here in Montana to help make that happen. You're taking great advantage of the state trade expansion program. And if you don't know about that, you should find out about it, because it's basically free money to help businesses go out and tackle exporting. And I think I was talking to Wayne, and he says that in Montana, you burn through that money like that because you've got so many people that are interested in exporting and are able to take advantage of it, which is awesome. Take advantage of every resource that you can get your hands on to help move that forward. And in Montana, since 1998, exports have grown from 298 million to 1.06 billion now. So again, Montana's making it happen. I think your number one trade partner is Canada, but you're doing business with Mexico. I mean, NAFTA was huge, right, for opening those borders, but you're doing a lot of business with China too. So again, for a relatively, for a smaller state from a population standpoint, you're doing a lot of good work in taking advantage of the economic benefits of exporting. And just as far as the number goes, Montana in 2017, almost $500 million to Canada, $100 million to China, $76 million to Korea. So getting out there, getting to Asia, which is probably the biggest growing marketplace, it's commendable. Especially, you're not close to any of the normal, what we consider centers of trade in the country. So making that happen is kudos to everyone here. So I was going to tell you about a little story about a company that I ran into in Illinois that I just like the story because they've been in business for like 80 years, and they started exporting like 5 years ago, and they basically tripled their business. And what they do is they make ice makers. So not like your regular ice makers. It's, when you go to the grocery store and they have all the fish on ice there, they make these like heavy duty ice makers that have to basically run 24/7, 365. And almost all of their business, or not, a significant, probably 30% of their business right now is in China. And, these are, it's like, it's a freezer with, it makes ice. It's kind of like, you'd think that they could repair it, but they've taken advantage of a couple things. One is because, there's some issues with IP and stuff like that with selling into China. And what's happened is they haven't run into any competitors that can make the same product with the same quality that they make it. So they've got that, and there's like a name thing. So people there like having products from the U.S., or at least this particular product. And when I was speaking with them, like their salesperson was pulling out his card, and he had like money from China, he had money from Taiwan, like all these different places, because they're constantly banging away at it. But it's just really cool to hear that they are extremely successful in that marketplace, which is very difficult for U.S. businesses to go into. And I guess it's this little shop in Chicago that's able to get out there. It just should give some courage to other businesses that have great products that you can go into those more difficult marketplaces and still be successful. And then the last thing I was going to touch on related to, it's not really exporting, but it kind of is foreign direct investment. So that's another way that I've seen as I've been traveling around where we've been getting more investment to build more businesses here. I think Wayne told me about an example of a ADF Group, a Canadian company that built a 100,000 square foot fabrication plant in Great Falls. And we see those examples all the time across the country in these places where people see, hey, there are natural resources, or there's other things that the business can take advantage of to come invest in the States. So, again, that relates back to the workforce and all those things, but to continue to develop those opportunities, we want to bring as much capital in as we can because that just creates jobs in our local communities. So I really appreciate the time to talk about manufacturing, to talk about exporting. I did want to touch on the SBA. If you don't know who the SBA is, we look to help small businesses in three basic ways. One is access to capital. So we work with lenders and other partners to support basically loans to small businesses, whether you're a startup to you're an advanced business and you're looking for expansion funds. Across the board, we have resources and we work through partners to deliver those products. We have small business counseling. So if you want to start a business and you don't know where to start, you can go to the Small Business Development Center. You can go to Wayne and the folks in his shop that are partners with the SBA to actually help people navigate those pathways. And then finally, we help people access government contracts. So when we look at those opportunities to expand a business, we look at two things. One is diversification. So we talked about exporting. The other path is government contracting. Federal government buys about $500 billion of goods and services a year, largest single buyer in the world, and they buy everything. They buy pencil erasers, they buy tanks, they buy everything in between. So, it's a great opportunity for a small business as either the supply chain. I think there's a business out near Helena that makes parts for Boeing, right, to attach the wings to the planes. I mean, those little things are huge business and huge local businesses that are really important to that overall supply chain. So looking for those opportunities to get with those government contractors, maybe the big primes, to get in there, but also as individual companies. We help navigate that. We can help navigate that process. And there's certifications. So if you are a service-disabled veteran or a women-owned small business, there's resources available and there's special advantages in the contracting process for you. So I just say that to say that as you look and as you communicate with your friends and neighbors and you identify entrepreneurs or people that are looking to start a business, tell them to think about coming to the SBA at least as a starting point to get some information to help them make sure that they're being as efficient as possible in their process. Because when you're starting a business, my wife's an entrepreneur, so I know this from experience. You're like all in and the world's huge. You don't know what the first step to take is. And getting with Wayne and his team and the small business development centers and everybody else who's out there, this whole network can help people make that path as quickly as possible and be as successful as possible. So really appreciate the time and thank you.
Thank you. Thank you, Robert. That was great. Just a little bit of housekeeping. Again, we're going to be starting an HR panel here at 3:45. That's going to be talking about kind of workforce issues within Montana and how do we address them. Please go out, enjoy the vendors. Please thank our sponsors. You've seen them gone through the screens here. And please, one more round of applause for our speakers.